Hello and welcome to FidelityConnects. I'm Pamela Ritchie. The U.S. consumer is sending pretty mixed signals. High earners thriving, while lower income households certainly feeling the squeeze. From restaurants to travel, the divide is showing up in some surprising ways. So what is driving this pressure on the lower income consumer at this moment? And could some of these challenges actually create opportunity for investors? Joining us here today to explore what's behind some of the consumer shifts and where opportunity for you may lie is equity research analyst David Cochrane. Warm welcome to you, David. Good to see you again.
Good to see you. Thank you so much for having me.
Delighted to have you here. And we spoke with you in this forum. I mean, I felt like it was days after the April 2nd announcements. Is that about right? It's like maybe in May.
Yeah, we spoke in the spring right after that was announced, and we're back today with another interesting time in consumer land. And, you know, these are moments that kind of create opportunity, but we'll get into what's going on in consumer.
Well, let's begin with, so we dispel this or flesh it out for us, whatever. The K-shaped economy is what we hear. K-shaped consumer is what we hear. One, is this correct? And do you want to just fill us in a bit on exactly what that means?
Sure. Happy to. I mean, so to set the stage, consumer discretionary, it's a sector with high intra-sector dispersion, which is what that means is there's always winners and there's always losers in the sector, right? And we've been fortunate to have a good year at Fidelity in the sector, but it's been a really challenging place to invest this year. So markets up double digits, consumer discretionary is flat year to date, and you've had a lot of smaller pockets where there's been a lot of pain within the sector. And yeah, as you mentioned, it's really been a tale of two consumers, right? Okay. So the higher income consumer, they're hanging in. They're still spending. They're doing just fine.
They're earning, so they're spending.
They're earning, so they're spending. And the lower income consumer, that's where you're seeing some signs of weakness.
So at one point, there was sort of a reopening narrative not so long ago where, boy, did we need workers back in every regard. And it was actually hard to get people back to the office, back to their jobs, back to and so wages, in fact, increase to get people back to work. There was a period of time where a lower income worker within the economy was really enticed to come back to work. The wages were going up. Is that still the case?
So what you've seen more recently with respect to wages is the lowest. So if you go back a couple of years ago, the lowest quartile of wage earners were experiencing the fastest wage growth. And today, that quartile is experiencing the slowest wage growth. And the gap has actually widened in recent months. So that's one of the headwinds facing the lower income consumer. You're also seeing, you have rates continuing to put pressure on that consumer. Unemployment rates overall are fine, but you've seen unemployment rates tick up about 4% for younger consumer or younger workers who tend to be lower income. You've had things like the government shutdown, which of course it interrupts federal paychecks, right? But perhaps the bigger impact of that has been you have 40 million Americans on SNAP benefits, which are also known as food stamps, and those experience interruptions during the government shutdown. So of course, if you don't have money from the government to spend on groceries, all of a sudden you're going to spend the money that you do have on groceries, and that leaves very little for anything else. Plus, you've got consumer sentiment issues. So
take us through, for instance, also within this is, interest rates are falling. Directionally, they're going sort of in the right direction for a consumer, for someone who owns a small business, for instance, is employing other people. This is good. Of course, a rate cut doesn't sort of manifest itself in the economy like that, does it?
Yeah, it takes time for rates to flow through. And look, I'd love to set the stage of where we're at today. And then we can talk about kind of how we're addressing it as Fidelity. And then we can talk about, hey, maybe things like rate cuts that could help into next year. Mm-hmm. So where we are today, you're seeing some of those pressures that we talked about. Plus you have consumer sentiment amongst Democrats at all-time lows. You have Hispanic consumers pulling back, perhaps because of ICE. And you're seeing it in all types of different areas. So the first area you're seeing it in restaurants. People are just going to restaurants less.
Okay.
And you're seeing evidence of people trading down from more expensive restaurants to cheaper restaurants. McDonald's, they recently reported they're seeing nearly double-digit declines in visits from lower-income consumers, but it's offset by the middle income trading down. And then you have places like Chipotle, they reported their traffic's also down, and they're calling out that low and middle income consumer. And so that's an example of the weakness at the lower end. Another great example is hotels. So you've seen revenue per available room night is the statistic or the metric. And that's basically how much it costs to stay at a hotel. And that has continued to fall through the year in the US, the growth of that. But if you look at the high end luxury chains, they continue to charge more. They're doing just fine. People are showing up. But in the economy low-end hotels, rates are down mid to high single digits because people just aren't coming at that lower end.
So to clarify, this is the US. You cover the US. You're taking a look at sort of travel, leisure, consumer within the US numbers. We'll talk about Canada later, but I'm really interested about why this, because it sort of also seems a little bit like the direction of the stock market, some people would argue. Like there's a lot of pieces that seem to fit together for this K-shaped discussion, and you're filling in the pieces for sort of the bottom level. Those that are still spending, what types of things are they still spending on? Do we go into apparel from here? Where is this spending? So hotels is one, obviously, and restaurants that are high-end are publicly traded, so we don't know.
Again, so I mean, it's a divide. And so what you've seen is some companies that aren't as exposed to the low-income consumer, they're doing fine. Okay. But stocks of companies that do have some exposure, they've been doing poorly. And what you find in environments like this is when you get some macro weakness, the fundamentals are poor for these companies, and every company tells you, hey, it's because of the macro, right? And
your job.
So to come back to the prior point of consumer always having winners and losers, it's our job to go through and separate, okay, is this company really just impacted by macro, or is there something else structurally going wrong? And that's really where we roll up our sleeves and the magic of Fidelity comes in, right? We have a deep research team. Right. We have phenomenal management access. So we're spending time with all the management teams, understanding what they're seeing. We have access to industry experts. We have unique data sets. We're building our models, doing our analyses, and just trying to separate. Basically, we're trying to answer three questions. One, is this just bad because of the macro, or is something else happening? Two, are there company-specific drivers that can drive the fundamentals in a way that is underappreciated? And then three, ultimately, what do earnings look like on the other side? And what does that mean for the risk reward, and how do they compare to consensus, right? So that's the work we're doing here at Fidelity.
So what if it is just macro? Is it just macro? Tell us about that. Sentiment, inflation expectations, like what about the macro?
Well, I think you are seeing a divide. I'll give you the example, an area I want to be careful from a compliance perspective, but an area where we're doing a lot of work is restaurants. And what we've seen is a broad traffic slowdown. But there are some restaurants where, yes, the macro isn't helping them, but they also have a competition issue. They have an issue with their value proposition, their cost structure. Yes, the stock's down, but estimates are still too high, and the stock is down, but still expensive. And on the flip side, there are some restaurants that have seen a slowdown, and it does seem to be mostly macro. And they've got some interesting company-specific drivers, which can help them accelerate growth next year, even if the macro is kind of more just stable, right? And so that's an area where we're doing a lot of work right now.
And I mean, it's very interesting because you'll hear a lot about groceries, you'll hear about, prices. How is that filtering through? I mean, the tariff story sort of fits nicely into almost everything that you cover, but you could go into the restaurant, the food, the side of imports essentially, and the tariffs that are being applied. Is this an area, are tariffs fitting into your macro story right now? I mean, they must.
So, I mean, tariffs, the way I'll talk about tariffs, they're kind of an interesting example of how environments like this create opportunity. So I was on the show in the spring, as you mentioned, shortly after the Liberation Day tariffs, right? And if you'll recall, that type of environment, it creates a great opportunity for us to do the work and say, okay, which of these companies will be able to mitigate these tariffs through supply chain initiatives, through pricing. and protect their margins and ultimately thrive, versus which companies are going to be very impacted directly in a way that's going to hurt them and hurt the stock. And a great example of that, I can talk about this because it's been a top contributor, or it's been a top position of the funds and a great contributor this year, so it's all disclosed, is Aritzia. So Aritzia, they're a women's apparel retailer specializing in everyday luxury. And it's a Canadian company, but they have a large US operation, and that's really where they're growing. So they're directly in the eye of the storm of the tariffs, right? And when the tariffs were announced in April, the stock was immediately hit.
It got thrown out with everything else. Yeah.
Exactly. And so what do we do here at Fidelity? Well, good thing is we already had a great understanding of the company. We'd spent a lot of time with management. We'd analyzed the impacts of tariffs even before Liberation Day. And so we had a good idea of the earnings power of the business. And so what's happened? One, company has done a phenomenal job mitigating tariffs. They've been able to shift their supply chain and improve initial markups to protect their margins.
So, because they do produce things in countries around the world that were slammed by tariffs.
Exactly.
So how did they shift that? Or, what's the example of how they shifted that?
So you can shift out of higher tariff geographies to lower tariff geographies. Net, you're still impacted by tariffs, but you're able to partially mitigate them that way. So they did some of that. They improved their initial markups and then have done a great job mitigating tariffs. But also the company has just done a phenomenal job executing in general, right? They've continued to grow in the US. The US growth comes with higher margins. They've continued to grow online. All of this allows you to leverage your fixed cost structure and grow margin, expand margins. And then more recently, they launched an app, which you may have seen, which went to #1 in the US and the Canadian app stores. So all of this has driven earnings growth in excess of what consensus expectations were. And we love to say at Fidelity, stocks follow earnings, right? And it's been a phenomenal contributor to the funds, up 90% since before tariffs were announced and 160% off the bottom. And this is a great example of where environments like this, like tariff announcements, like low-income consumer weakness, can create opportunity for those that are able to do the deep work and understand, okay, which companies are going to do well on the other side versus which aren't.
How have they kept pricing up? Again, out of the pandemic, again, this is years ago, but these things go in cycles. There was a period where lots of companies that had pricing power used it. And then you sort of thought, well, that's kind of it. I mean, they've raised, and that's great that they can do that, but they're kind of up at the high levels. How did Aritzia maneuver that? Or if did they?
So the team has done a phenomenal job curating great apparel. They price very reasonably versus competitors, and they have a tremendous amount of heat around the brand, and that gives them license to improve their what they call initial markups and protect the margin. So, I mean, they've done a great job, and that's part of it.
Okay, that's amazing. So what about with tariffs in other parts? Is that sort of, because at the moment it appears that tariffs are becoming less onerous. I mean, there's headline news about what the Trump administration is planning to do in peeling them back. There's also court cases going on. They're lower than they were when we spoke last. That is for sure. Do you have some confidence that it continues to go in that direction and works well for companies like Aritzia, but others?
So what I'll say is, if I look at what we're trying to do, a level set, and then we can talk about it into next year, including tariffs.
Okay.
So what we're trying to do is separate stocks that are impacted today by this low-income consumer weakness and say, hey, if the macro environment is more stable, what do earnings look like? And are there great opportunities that have come about because of this macro weakness? We're not necessarily trying to say a bunch of things are going to get better into next year.
Okay.
But there's an interesting argument for why they should, right? And what that does is provide a layer of upside optionality to some of these consumer investment ideas. So why might things get better into next year? As you mentioned, you're seeing some signs at the margin of tariff relief, certainly since the peak, but you saw agriculture tariff announcements last week. You've had SNAP benefits come back online. Next year, you should have larger tax refunds because of some retroactive tax credits. Plus, there's some new tax breaks in 26. Then you've got Trump talking about, on the other side of tariffs, he's talking about $2,000 stimulus checks called tariff relief checks.
Not popular with everyone, but could go very well for your sector. Yes.
I mean, hey, you want to keep people happy ahead of the midterm elections, right?
Sure. Okay.
So if you send out checks, I mean, you put all this together, maybe you get rate cuts, maybe you get...
or maybe you sort of feel the rate cuts.
Yeah, maybe you feel the rate cuts, maybe you get rates coming down, tariffs coming down. So again, I'm not a macro guy. I'm not looking into next year and making a big macro bet. We're looking at stocks that can work really well, even in a more stable macro environment. But as you mentioned, there's kind of some of these interesting upside levers into next year that adds maybe a layer of optionality on the upside.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to FidelityConnects, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
So take us through some of the other areas of the consumer that you follow, that there are stocks within that you take a look at. Travel is one, travel and leisure. Restaurants, I guess, fits into sort of the leisure side of things. What about travel? I mean, we've heard everything from people aren't traveling as much. There's actually totally full planes. Nobody can get airplanes built fast enough. So there's a supply issue. Take us through sort of the travel psyche and how it's impacting your view on the whole industry.
Sure. So I think the big theme in travel, specifically hotels, is that the big continue to get bigger, right?
Okay.
The large companies continue to win. So in the US, you have the two largest players, Marriott and Hilton. Their brands make up about a third of the market. It's lower internationally. And they grow at, call it 2 to 4x the rate of the market in terms of rooms. So why is that? I mean, why are these...
building new rooms? Or
in terms of the number of rooms under their banners.
Got it.
And so that's a big theme in hotels, is why are these big companies continuing to win? And there's a couple reasons. One, if you have Hilton on your hotel versus you have Dave's Hotel, you can charge more for the Hilton, right? No one wants to stay at Dave's Hotel. Yeah. They have loyalty programs. They can drive traffic there, brand recognition. So you can charge a premium if you're a Hilton or a Marriott. Secondly, these companies are able to spend marketing dollars much more effectively than I could if I was just running my own hotel on my own.
What's that mean?
So they have advantages in terms of better deals with the online travel agencies. Okay. They have brand recognition. They have scale and technology. And so if I'm out there trying to spend my little marketing budget, I'm probably going to be worse at it than if I give it to Hilton to spend on my behalf.
Got it.
And then third, the bank would rather lend to me to build a Hilton than they would a Dave's Hotel, because they think people are going to show up to a Hilton and I'll be fine and they can lend me the money, versus they don't know if anyone's going to show up to my hotel, right? And so what you're seeing is the large hotel companies continue to take market share. Now, this isn't necessarily an underappreciated dynamic, and that's where the deep work comes in, of royalty rates and fees and margins and expectations and valuation and all the stuff that we focus on as analysts. But they're great stocks to keep an eye on as they're kind of long-term share takers in their industry. So ones to watch, I would say.
Long-term share takers, for instance, sort of the moat story there. But how is the industry itself?
So going back to earlier...
Maybe it doesn't matter.
Yeah, going back to earlier comments, so the industry, the revenue per available room rate, that's been slowing and it's now running negative in the US, but with that dichotomy of the high-end luxury consumer doing fine and those rates continuing to go up versus the low end really struggling. What's important is over time, typically you charge more for hotels than you did last year, right? Around 80% of the time. And these companies have franchise business models.
At all levels of, yeah.
Yeah, so that grows over time. They're franchise business models, so they don't actually own the hotels. They just charge a royalty fee, which is very high margin and capital light. And so despite kind of this weakness in some of in the revenue per available room night, the larger end hotels the stocks have hung in okay, because they continue to grow units and people can look to the other side, and there's not that much operating leverage in the businesses because of the royalty business model.
So with the franchise side of things, they get Dave to build the hotel. They don't have to get involved in it, and then they put their label on it, and there you go. It's a great business.
It's a great business.
It's a great business. So it's an area where the big get bigger, it sounds like.
Yeah.
From that perspective.
Yeah, certainly advantages to being a big player.
So layer on top AI and its immediate effect. It's sort of, this is a question for everyone. Is it accretive in the next 6 months to a year? Is that useful? Okay, we get the agenting side of things. Everyone can book their travel faster. How does it work ultimately for instance, the hotels within this? Anything there yet?
So what I'll say about AI, the bigger debate around it in travel relates to the online travel agencies.
Yeah.
So Booking.com, Airbnb, Expedia.
Mm-hmm.
And
can it blow those out of the water? That's sort of
it's kind of similar.
Story.
There used to be this debate that would wax and wane about Google search adding more and more features that relate to booking hotels directly into Google search. And the fear was always, hey, Google search will circumvent the OTAs. You won't book your hotel on booking.com.
The OTAs are the online travel
agencies.
Yes. So.
Thank you. And that was always the fear. The debate today is similar, but it's about AI, right?
Okay.
We're using ChatGPT to plan our trips.
Yeah.
Google recently announced some new features in their AI mode related to travel planning. And the concern, the bear view, I'll take you through the bull bear for the OTAs, but basically the bear view is that you'll book directly through an AI agent instead of going to booking.com, right? The bull view is a little more nuanced, which is the OTAs have historically been some of the largest advertisers on Google, right? Okay. And part of the reason for this is the OTAs can generally pay more for an advertisement than an individual hotel. Because if I pay for a Google ad and you click on Dave's Hotel and you go, Dave's Hotel looks trash, I don't want to go there, that's it, right? I've lost the sale. But if you click on Dave's Hotel in booking.com and you don't want to go there, you probably scroll down, pick another hotel, and Booking makes a sale, right? So that's one piece of it. And maybe that dynamic persists with AI agents, right? Where they're able to pay more for an ad.
It sounds like Google is the key here.
Yeah, I mean, certainly it's good to be Google, right? And so that's one piece of it. Another piece of it is these OTAs, they're more than necessarily just booking tools. They're networks and they offer other services. Okay. So if I was renting a room in my house and I'm renting it through Airbnb, do I want to integrate directly with ChatGPT and have millions of rooms integrate directly with them? Or do I just want to have Airbnb do that integration on my behalf, right?
Well, I don't know. How is that looking? Because it sounds like the perfect job for agenting.
Yeah, I think generally it's easier if Airbnb, the bull argument would be it's easier if Airbnb integrates on your behalf, right? Okay. And then they also offer services around payments and being the merchant of record, et cetera. Okay. So
are there deals between, for instance, ChatGPT or any of them really with a lot of these OTAs? Like, is that actively happening? Is there some circular finance going on here? Like, what's happening there?
Certainly not circular finance going on, but what you're seeing is, I guess a good example would more be in hotels, right? And this is the bear case, which is a real bear case. So you've seen Wyndham, they recently announced working on a project to make it easier for them to integrate with ChatGPT and other AI agents. So that's an example of a hotel going direct into the AI agents.
And
so
ultimately, we don't need a website. We'll just let, let this take over to
or
an
we don't
extent.
need to pay booking.com.
Right.
And so that's kind of the bull bear debate. So far for the online travel agencies, you've seen continued room night growth. And that's going to be the key to keep an eye on that as more and more of these features get introduced. Right. Just seeing, hey, are they starting to impact the room night growth?
It's really interesting, though, because sometimes the conversation sort of gets away from everyone. And in terms of investment, you might think that those OTAs kind of get thrown out with the bathwater to an extent. But I think what you're saying, or it's interesting, that people may not change that quickly.
Yeah, I think it will take time. And that's part of the challenge with some of these AI debates is you're almost fighting a ghost in the near term.
A little bit, yeah.
Because you can't prove or disprove it. And you can argue both sides very reasonably. And so sometimes that creates opportunities, sometimes it creates risk. And it's really, at Fidelity, we're diving into both sides of the argument, keeping an open mind as we do our research to ultimately try and come to the best conclusions we can for what it means for the stocks over the medium and longer term.
It's fascinating to know what it means for, as you say, sort of the medium term, even though the conversation right now is so heavily there. That doesn't mean that every single person is going that route. Tell us a bit more. Maybe this is hotels, maybe this is everything. The discussion of housing mortgages, we go back to sort of the macro story. But in Canada, how is the consumer? Because that does tend to get tied to, a mortgage story in a lot of cases, or a housing story, an affordability story, certainly. Are we in the exactly comparable K-shaped economy that the U.S. is in? What are the nuances if there are differences?
Yeah, so the Canadian consumer, from my perspective, is not in great shape. Unemployment's around 7%, so it's higher than in the U.S. Rates have been coming down, mortgage rates have been coming down, but home prices are still coming down as more and more of those COVID-era mortgages come up for renewal.
Well, we're right in the storm that we had expected, but it doesn't seem to be as stormy as we thought. What do you think?
So I think what's important and what we're focused on is rate of change, right? The Canadian consumer is not in great shape, but they weren't in great shape last year. Versus the US, maybe you're seeing more of a dramatic rate of change. And rate of change with things like low-income consumer falling off or the tariffs announcements, these are the types of things that create the opportunities to go dive in and say, okay, which of these stocks has sold off too much and where is their value on the other side, right? And so we're really focused on the rate of change, and maybe you're not seeing anything as dramatic in Canada as what you're seeing in the US right now.
Would you go so far as to call it a trough here, and therefore the other side is looking closer than perhaps in the US?
I would say, look, again, I'm not a necessarily macro investor. What we look to is understanding, being macro aware, what's happening. And then it creates a chance for you to do work on some of the impacted companies and say, hey, if macro is just normal, what does the risk reward look like? What do earnings look like? What are the companies doing to drive earnings independent of the macro? And then you can kind of say, well, if macro is better or worse, what does that mean? Versus make a macro prediction on what's going to happen and bet on that necessarily.
You mentioned this kind of at the top, just the differences and where there's winners and losers. Across the U.S., is it divided into states? Do you see that in separate regions of the U.S.? Is there something, again, nuanced there about the consumer?
So what you've seen, a couple companies have called out weakness in Democratic areas, and there's a survey of Democratic versus Republican consumer sentiment. Interestingly, Democratic consumer sentiment is at basically all-time lows, below COVID, below the GFC, which is quite remarkable.
Gosh, it is.
And if your sentiment is poor, maybe you're less willing to open your wallet, right?
Right.
And so you're seeing some impacts there. You've also seen, related to the government shutdowns, most likely companies that have exposure to the DC area see some weakness, because if your paycheck's being interrupted, maybe you're not going out for lunch, right?
Yeah, absolutely.
So there's nuances there.
So you take all of this information to help you make decisions, for portfolio managers to help them make decisions. Is this, it sounds like there's a lot of nuanced, not awesome stuff there. Does that mean it could actually be an interesting time for you to enter and go shopping for shopping stocks? Certainly.
These moments, while they feel challenging during it, just like when tariffs were first announced and all the stocks sold off, it's often an amazing time to hunt for new ideas because all the stocks sound bad and they all sell off together. And here at Fidelity, we're doing the work, we're talking to the teams, we're building our models, we're going through the data, talking to experts, and we're trying to separate those winners and losers and take advantage of moments like this. That's really what it's all about.
It's amazing. I'm so glad you have eyes on that for everyone else. Joining you here today, David Cochrane, thank you for being here.
Thanks so much for having me. Hopefully helpful. I had a lot of fun.
Have a great weekend.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.